everyone, and welcome to the Sustainable Finance Podcast, where you can learn everything you want to know about sustainable and impact investing from leaders in the field. I'm Paul Ellis, your host for these weekly conversations about developments in this fast-growing industry. My guest today is John McCartney, Managing Partner and Founder at Artesian Impact Partners. John is head of Artesian US and is responsible for Artesian's North American fixed income and venture capital business. He maintains the firm's relationships with the investment banks, and broker-dealers in the North American fixed income markets, as well as monitoring the later stage investments from the startups that have graduated to the U.S. market. Hello, John, and welcome to today's program.
Thanks, Paul.
Please tell our Sustainable Finance Podcast subscribers what kinds of later stage investments have graduated to the U.S. market from the startups that Artesian has worked with in the past.
Yeah, thanks, Paul. We've only really had a handful of Australian companies graduate from the Australian domestic market to the US, and they're mainly ones that have concentrated on bigger US type themes. So things like on-demand fashion, infrastructure security, and social media tracking and analysis. But from a perspective of isolated innovation markets like Australia, they're generally characterised by smaller, nimbler companies that are managed to take advantage of regulation or other localised market topographies to outperform bigger rivals. So as such, the smaller VC markets like Australia tend to have more trade sales in terms of exits rather than having to come to the US to do big IPOs. Now, having said that, we have about 260 odd portfolio companies in Australia and 140 in China. So we are growing, but we are starting to see that it's not become as necessary for companies to actually move to the United States to get exits, if you like. So to become unicorns, they're staying at home longer, and we're finding that the local VC markets are funding them longer right through to exit. So whilst I have that responsibility, we aren't seeing a lot in terms of the majority of the portfolio.
So I think what you're saying is that these companies can now get later stage funding within their own markets. Is that correct?
That's
or
right.
Some of them can anyway.
Yeah, we're seeing the VC markets in Australia and China build out a lot bigger, so they're not having to come to the US, if you like, for validation of their market or for exiting, basically.
Got it. John, in the Artesian High Impact Green Bond Fund Information Memorandum, there's a section dedicated to discussing resilience and anti-fragility, in which you articulate a holistic approach to combating anthropogenic or human-caused climate change by combining dark green bonds and dark green venture debt in a transformative and sustainable solution to actively address the climate-resistant infrastructure shortfall. Tell our listeners what the climate-resistant infrastructure shortfall refers to, and then we'll discuss what you mean by dark green bonds and dark green venture debt.
Thanks, Paul. Well, the science tells us we can pump about 2.9 trillion tonnes of carbon into the atmosphere before we hit the 2 degrees Celsius tipping point for climate change to unleash its more disastrous sort of consequences on the environment.
Sure.
Since 1870, we've pumped in about 2.16 trillion tonnes into the atmosphere. So our carbon budget left is about 0.74 trillion tonnes. And with about 40 billion tonnes going into the atmosphere per year, it's giving us about 15 to 20 years before we hit that 2 degrees Celsius tipping point.
I see.
Now, the IPCC has told us that we need to replace about $90 trillion worth of carbon-based infrastructure and put it into new climate-resistant infrastructure. So $90 trillion over that time period, 15 years, is about $6 trillion a year. Now, with regards to that deficit, the governments around the world under the Paris Agreement had agreed to about $5 trillion of that. But that still means we've got about $1 trillion per year that is not being funded, and the problem is compounding every year. So the idea was, and this was supposed to be done by the private sector, and the World Bank and the European Investment Bank recognised this back in 2008 and started issuing the first green bonds to try and agitate for private capital to come in and fix this specific gap that we've got.
I see. So that's where your green bond fund comes in, and where the green bond market actually was launched, as you're saying, through the international banking system.
That's correct. So
Original.
and this year we're probably going to have about $225 billion worth of green bonds issued. So you can still see we've still got a massive gap of around 800 billion of this climate infrastructure shortfall that still needs to be funded.
Okay. So now the Artesian High Impact Green Bond Fund will invest in green bonds, venture debt, and other green fixed income securities, such as asset-backed securities related to clean energy infrastructure projects or climate change mitigation projects. The fund's mission is to displace the maximum amount of carbon while ensuring capital protection and the highest rate of return possible. So tell our subscribers how venture debt directly supports innovative and disruptive clean tech projects and solutions that can have a deflationary effect on the clean energy infrastructure funding gap that we just heard about.
Yeah, so as I mentioned, we've got this infrastructure shortfall, but at Artesian, with this barbelled business model with venture capital and fixed income, we saw that we were acutely aware of the deflationary power of technology, in that that's basically using technology to make more goods with less inputs. And the idea here is to not concentrate on just doing venture capital equity, which we felt that has too long a lifespan for it. It's normally a 5 to 15 year type lifespan for an equity investment from seed through to exit. We felt that venture debt provided a much better time scale because it's normally 36 to 42 months in terms of a debt security, and it's an amortizing type schedule. So it's quite short dated. The yields are quite high, normally anywhere from 10 to 20%. And also, we're looking at companies here that have got through the proof of concept stage. So what we know is that they are going to have an impact on the climate problem, but what we're trying to do is offer non-dilutive capital to these companies to try and get them through to commercialization to bring forward their impact on the climate problem. So the idea here is to provide this capital to these companies to bring forward their impact to make sure that we bring down the amount of carbon that's being displaced into the atmosphere currently.
I see. So now how much can private market funds like Artesian's impact the global infrastructure funding gap over the next 3 to 5 years? You mentioned that there's this big deficit even after governments contribute to the process.
Yeah, look, I think that it's difficult over the next 3 to 5 years, but what I can say is that we've seen a very large jump in the amount of startups entering into the clean tech space. So the global clean tech 100, say back 3 years ago, had about 4,000 applicants. Then in 2017, I think it had about 7,000 applicants. But last year it was about 14,000 applicants. So what we're seeing is a lot of clean tech startups coming into the space. So we feel that by building this fund, we'll be in a great position to take advantage of those startups as they move through the life cycle of clean tech.
Now, what kinds of technologies are you seeing that are driving the growth in this part of the economy? I mean, I would imagine it's a lot of different technologies across a lot of industries. Is that right?
That's right. I mean, there's two sides to it. I see it as having both a supply side and demand side type equation. So you're getting on the supply side, you've got bigger capex involved with trying to do things like tidal or wind or other sort of renewable energy type projects to supply energy onto the grid. And then you've got things like SaaS solutions or software as a service type solutions to try and bring down the demand side of the equation as well. And we'll be investing in both of those.
And where do you source those kinds of opportunities in developing and developed markets around the world?
Yeah, at the moment still the majority of venture debt is being created out of Silicon Valley. So the majority of the debt will come out of there. There are places in Europe as well, but the yields and things tend to be a lot lower there. In the United States specifically, we've partnered with, because we have our own clean tech seed fund in Australia, we've partnered with other investors in the United States, VC investors, and they provide us that deal flow coming into us.
And so venture debt then sounds like a way for investors with an appetite for risk to make portfolio selections where they can expect a significant return on at least part of the capital they put to work in a fairly short number of years, and perhaps have the rest of that capital positioned for longer-term growth? Is that part of the process?
Yeah, that's possible. I mean, part of the venture debt securities means that the venture debt providers do get some equity warrants associated with the loan. So it means that you do get some equity payoff, going forward. The real issue is the size of being able to do this. At the moment, it's still quite a small industry. It's probably the clean tech represents probably 10% of the venture debt market. So we estimate it's anywhere between $2 and $3 billion a year of clean tech venture debt that gets done. So it's not easy to scale this idea, if you like. There's only a small amount of opportunities, but we see it growing. As I mentioned, the Clean Tech 100, seeing that massive growth over the last few years, we feel that there's going to be a lot of opportunity going forward.
And are most of the Clean Tech 100 companies in the developed markets at this point, or?
They are. Although, with China and India importing the majority of their energy needs, we feel that those guys are going to be a great engine for growth going forward. So we see Asia as being one of the cradles for, generating a lot of this risk going forward.
Okay, great. So now, John, prior to co-founding the Artesian Group in 2004, you spent 9 years at ANZ Banking Corp, where you held a series of securitization and trading positions within the capital markets group, including head of government bond trading across Australia, New Zealand, and India, and head of the international credit trading group. Now, what kind of personal motivation encouraged you to co-found the Artesian Group, and what kind of impact can firms like yours have on the private market ESG investment framework across both the large and small economies in Asia?
Yeah, thanks, Paul. Well, I mean, it's always hard to know why you start these things, but I think it's a confluence of events, but it really comes down to the people who you're working with. I think that you've got to know and trust the other partners who you combine with in the business, and look to try and align your strategic goals with them. And I think one of the things that we really believed in was that a boutique firm like Artesian could make a difference. We spent a lot of time creating these early stage ecosystems to be able to create this larger platform or venture capital platform that we can then harvest for really good ideas in terms of impact. And specifically on clean tech, I feel that in 2004 when we started the firm, there wasn't the products for us to be able to deliver the sort of impact related products that we're looking to do now. So I feel like a boutique firm like ours has got a very big role because we can move quite faster, more nimbly than some of the other larger firms to be able to deliver these products before they can. And specifically with something like the climate crisis, we really have to get the job moving quite quickly. So I feel we've got a big role in doing it. But specifically for ESG and the Asian markets, I feel that with what we're doing with the seed capital platform means that we are imprinting our governance view on what should be happening with these companies at a very early stage. So it means we're giving them a very good platform to be able to grow in a sustainable way.
So that means that you are supporting their development along the types of metrics and reporting guidelines that as those firms grow, they will need to continue to follow and expand on in order to attract more sustainable capital. I think that's what I'm hearing.
Correct.
Yes.
But I think by using a DNA stamp with them early when these companies are just being formed,
Yes.
it gives them a longer term view about how to grow and what to do. So and in a responsible way.
Okay. Now, how many deals do you look at on an annual basis? There must be thousands of companies out there trying to get the attention of firms like yours.
Yeah, that's right. Well, we partner with incubators, accelerators, universities to deliver the deal pipeline. So ours is a co-investment model in that we have to see those guys investing before we invest alongside them. But what it does do is it creates a scalable platform for us to generate risk. And what we're doing for our LPs is be able to deliver them a de-risk pipeline of investment opportunities, especially for the late stage type investing.
Okay. You mentioned the university incubators. How big a part of your work is that in places like Australia and developing economies in Asia? Is that significant, or is most of that happening in the more developed economies?
Yeah, no, I see it happening more in the developed economies. And I feel that as Asia grows and gets bigger, that we'll start to develop these ecosystems throughout Southeast Asia as well. But in China specifically, we're really connecting with incubators and accelerators at the moment. But the universities we haven't tapped into quite yet.
Okay, is the same true of India as another large developing economy, or is it different there?
Yeah, look, we haven't gone into India yet.
I see.
We feel that China and Southeast Asia is probably where we're gonna concentrate on for the moment. And there we see that that market there is too nascent at this point in time. Vietnam, Thailand, for instance, Myanmar is probably a little bit too early for us to start getting the investment. It is starting to grow. We feel that in 2 or 3 years' time, that's going to be a major source of innovation.
Particularly around clean tech.
Yeah, that's right. We feel that as regulation starts to bite, we're going to start to see a lot more innovation happen around that. Regulation is a big catalyst for innovation.
Mm-hmm. How about, and now here in the U.S., it seems that at least when you read the newspaper, it seems like we're retreating somewhat on our regulatory infrastructure when it comes to more sustainable energy industry development. Is that affecting the way that your fund operates or your business in any way?
Yeah, look, I think that's probably very true on the federal level, but if you look at the state level, I feel that the states are really putting together their regulations to try and make up for where the federal government has sort of dropped the ball, if you like, since the Trump administration has come in.
Right.
And California is like the 5th largest economy in the world, and they're really driving a lot of the change.
And aren't there I think there's over 20 states, I believe, in the U.S. that now have some sort of renewable energy standards in place for the next 5 to 10 years. Is that correct?
That's right, and we see it growing. If you look at what's happening over in Europe, their green bond programs are getting tighter and tighter. So there's 2 different types of green bond principles, if you like, in place. So there's the Climate Bond Initiative, which is a more stringent and probably makes up about 15% of the market. And there's the Green Bond Principles, which are more voluntary, if you like,
yes.
and much wider for the green bond issuers to use. And that makes up about 85% of the market. The European taxonomy or framework that they've just put together for issuing green bonds in the European jurisdictions are more towards the CBI, so they're becoming stricter. And what we're finding is that over time, or what we feel is going to happen over time, is you're going to see governments putting in heavier and heavier regulations trying to avert the sort of, the nastier effects of climate change going forward.
And so a green bond market that will develop more along the lines of let's say, the European taxonomy over the long run, perhaps even here in the U.S. as well.
Absolutely, and I think the Chinese market is getting bigger. I mean, they're issuing only in renminbi at the moment, but they're looking more at the US dollar type markets, and we're looking for their taxonomy to start reflecting what we're seeing offshore as well. But they've got a lot of infrastructure to put in. In fact, we feel that the greatest place to be putting money to work in terms of impact in terms of green bonds is Asia, because that's where we see the GDP growth. And that's also, where the population growth is coming from, and that's where the infrastructure is required.
Now, I was recently doing a podcast with an asset manager here in New York who focuses on the green bond market, but in the developed economies. And she was saying to me that she and her team have now developed a system that allows them to narrow the metrics that they make their ultimate portfolio decisions about, and again, this is in the developed markets, down to about 6 metrics per issuer on a portfolio strategy that may own hundreds of bonds, but on a per issuer basis, they now have it down to just a handful of metrics. Is that realistic in your part of the business? Or?
Yeah, no, I feel that what we're looking for is actually to look at a carbon yield for the portfolio. So what we're trying to do is work out not only the the financial yield, which is the yield we're getting on the bonds, but also the carbon yield, or how much carbon is being abated from that particular security. Now, it depends on who the issuer is, how much transparency we get down to the asset level. The more transparency we get, the better or easier it is for us to be able to make an estimate of what that carbon abatement is. But we're really looking for the dark green end of the spectrum. So what we're looking for here is the bonds that are making the biggest difference in terms of carbon abatement. So for us, that means anywhere from 800 to 2,000 metric tons per $1 million of capital invested.
Okay. Now, is that here in the U.S., the municipal bond market, of course, is a completely different animal, if you will, from the corporate market. But is that playing any role in the work that you do and that other people are doing in the green bond markets at this time?
Yeah, no, look, I think the municipal bond market is definitely a great catalyst for change in terms of the green bond fund or the green bond markets. But in terms of our specific fund, because we won't be able to collect the tax credits associated with the muni issuance,
correct,
then we won't be concentrating on that in our strategy.
Okay. Well, John, this is a fascinating subject, and there's a lot more to talk about, I'm sure. But I think we're getting close to being out of time for today. So
that's great, Paul.
We're going to revisit this in the future, if it's okay with you. We'll come back for an update on how your fund is doing and how the market is growing. And I want to thank you, John McCartney, Managing Partner and Founder at Artesian Impact Partners, for joining me today on the Sustainable Finance Podcast. Now, John, who on your team can our listeners contact for additional information about Artesian Impact Partners and the Artesian High Impact Green Bond Fund?
They can come through to myself, John at artesianinvest.com, or Gerald at artesianinvest.com. Both of us can answer your questions, or you can visit our website at www.artesianinvest.com.
And your office, you have a permanent office here in New York that you're the senior or the managing partner for here in the U.S.
Yeah, so we've got offices here, London, Singapore, Shanghai, Sydney, and Melbourne.
Okay, great. So I want to thank our subscribers for joining us this week, and please do join us again next week for another episode of the Sustainable Finance Podcast, as well as quarterly sustainable finance webinars, which feature panels of sustainable and impact investing experts like John McCartney and dialogue about important developments in the industry. I'm Paul Ellis, your host for these podcast and webinar programs, and this is the Sustainable Finance Podcast.